Hello YouTube, it's Victor from TRADEPRO Academy, and today we've got a super special video for you as we near our potential rate cut decision from the US Fed. So in today's video, we're going to be talking about the rate cut cycle potentially in 2019 and 2020, and is this a recession protection cycle? We're going to go through everything you need to know for this upcoming rate cut and the ones to come. So in July, the Fed cut rates for the first time in over a decade, and Jerome Powell, the Fed chair, said that this was not the beginning of a rate cutting cycle, delivering a more hawkish tone which prompted markets to drop. Fast forward to a few weeks later, and we've got at least two rate cuts priced in by the end of the year. So in today's video, I'll be breaking down the Fed rate, what it is, what it means for you, what it means for investors, traders, and everyone else, along with what it means for the future and current economic conditions. So again, today we are going to reiterate what is the Fed funds rate, how do interest rates affect markets, why does Trump want a rate cut, and why is it the wrong time to cut, along with what can we expect from all these cuts. Now, what is the Fed funds rate? The Federal Reserve moderates the US economy and moderates the monetary policy and makes decisions to change this monetary policy based on their economic outlook. The Fed funds rate is not the interest rate at which you and I are able to borrow money, unfortunately. It's the interest rate which banks and other depository institutions lend money from one to the other. Now, this is on an overnight basis, and the current rate is 2 to 2.25%. Just today in Switzerland, Jerome Powell mentioned that the approximate rate is 2.1%. 1 year ago at this time, the Fed's fund rate was the same. So why is it used? The Fed fund rate is put into place due to banks having to keep a percentage of their clients' money on reserve, where they can earn no interest on this money. So banks aim to stay as close as possible to the reserve limit, and the goal is to not go under said limit, which presses them to lend money back and forth to keep it at that level. The federal funds rate is used to moderate the supply of money and funds, which is used to monitor inflation and other interest assets. The general prognosis is that when rates are hiked, the Federal Reserve makes it more expensive to borrow money, lowering the supply of money and increasing the short-term interest rates, effectively keeping inflation in check. To the opposite end, in our case, if the Fed cuts rates, it makes money cheaper to borrow, increasing the supply of money and increasing the potential to invest, decreasing short-term interest rates. This is how we entered the current potential rate cutting cycle. Now let's talk about how does the rate affect the market. So as we just mentioned, first, the traditional effect of rate alteration. In this case, the rate cut would have a positive effect on equity markets. This because money is cheaper and this is attractive to investors to borrow and invest into these rising equity markets, which makes markets climb. In just a bit, we will talk about why the last rate cut, July 31st, we saw a downside slip in the markets, as you can see on the screen right here, from these 3,018s on the S&P futures down to 2958, a significant 50-point slip. So it's not really what's supposed to happen during a cut, but the whole psychological effect on the market and its participants. Next, let's talk about the effects of the rate cuts on the US dollar. So when the Fed cuts rates, investors look to sell dollar-denominated assets to buy foreign assets, which makes the US dollar drop in value. There is not as much demand for the US dollar, while other foreign currencies tend to increase in value because foreign assets are more attractive for investment. This is what the US and President Trump want in order to increase global trade. So we'll talk about Trump and his stance on the rate cuts very soon. So where does money flood in? Safe haven assets such as gold rise when the US dollar drops in value. Gold increases as it is a direct flow of money from one currency asset to a commodity asset. Next, let's look at bonds. Bonds are typically inversely correlated to the stock market, so bonds rise while stocks fall. If interest rates help stocks rise, wouldn't that mean that bonds would drop? Well, not necessarily, because when interest rates are cut, since bonds and rates are inversely correlated, bond prices tend to increase, moving in tandem with the stock market and cut environments on a shorter term. The lower rates enable debt issuers to issue new debt on lower coupons, effectively making the higher yield debt or the higher coupon more in demand, increasing the price of that bond. For example, would you rather have an 8% coupon yielding bond or a 2% coupon yielding bond? Naturally, 8% to earn more, right? So those previous higher coupon bonds are going to be more expensive. They're in higher demand. In current conditions, bond yields have dropped to new lows day by day. This next rate cut could put further downside pressure on yields, which has the risk of widening the spread between the yields and the S&P 500. So we've seen that chart multiple times at TradePro. Usually yields and the S&P move in tandem. However, there has been a huge, about 50% discrepancy right now, which could cause further catastrophe in the market. So we'll discuss the repercussions of the cuts shortly. However, there is only a few alternatives in this case. Should the S&P continue to rise and bond yields continue to fall, they will have to recorrelate, and either the S&P drops a lot or bond yields rise a lot, which is a little less likely, or they meet somewhere in the middle, which would cause the S&P to drop a significant amount. We're talking about 15 to 20% here. So finally, why does Trump want a cut? First, why does Trump want to cut so badly? We're trading near all-time highs, the market is doing well, and apparently the economy is doing well with moderate global slowing. But Trump is still mad at Jerome Powell and the Fed for not cutting rates aggressively. He has called for a 100 basis point cut. That would bring the current rate down to 100 to 125 basis points. Keep in mind, the Fed could cut aggressively from the usual 25 basis points to 50 basis points. So why does Trump want this rate cut? One, it's to help reach markets hit a new all-time high, which he thinks should be possible and should be the case, which would help his reputation. He's said time and time again that U.S. equities should be trading thousands of points higher if the Fed was doing its job or cutting rates. Two, it would help him drastically in the whole trade war conundrum with China. A drastic rate cut would weaken the US dollar, which would effectively increase global trade and help the US increase their global trade as well. He and the US were recently infuriated with the labeled currency manipulator in China to weaken their currency against the US dollar to get the upper hand in the trade war. A weak home currency increases trade for home exporters by increasing the demand for their cheaper products. Trump wants a weaker US dollar to decrease the US trade deficit as well. The falling dollar can positively affect the international business and global economy. When the dollar is strong, banks hate lending for trade finance because it costs them the strong dollar. With a weak greenback, they are way more likely to do so. Now, finally, Trump is upset that global central banks are cutting rates aggressively, and he wants the Fed to do so as well. He keeps reiterating that Germany is getting paid to issue their debt at NERP, so negative interest rates. And Japanese rates have been so low for decades. They have been on an everlasting stimulus package, and it seems that it is not sustainable or not the most sustainable course of action with the immense debt taken on. This puts a lot of pressure on the Fed to conform and continue to cut rates and masks this mid-cycle adjustment, quote unquote, when in reality it seems like there is more of a recessionary insurance move going on in these rate cuts. Now, why do we think it might be the worst time to cut? Why do a lot of people think it's the worst time to cut? The main point for not cutting rates is that it's way too soon. Cutting rates is a tool used by central banks to create more money supply to flood the markets and boost the economy through cheapness of borrowing. This is an insurance move when the economic data falls and markets drop, causing panic selling. The US markets are very well linked to the health of the nation's economy, and it seems that the Fed and Trump have been watching markets more than ever, more than they've been watching economic data, no matter what Fed Chair Powell says in terms of its economic dependency. Every little drop the PPT comes out, the Powell put gets activated, and dovish rhetoric comes out of the Fed to look for lower rates, which sends markets back to highs. Instead of waiting for economic data to present itself and paint a picture of a worsening situation, which is not yet the case, the Fed is cutting near all-time highs. The economic data out of the US is currently moderately strong, or at least stable enough, while the Fed funds rate is at 2%, 2 to 2.25, which is really low in terms of where the neutral rate is estimated to be. This is supposed to be an insurance metric which is supposed to help the economy when times are tough. Trump wants a 100 basis point cut by the end of the year. If that happens, the Fed funds will still be at 1% and markets will be trading near highs, or we assume so at least. So what happens when we go from the 3,000 level down to 2,700, 2,500, or 2,000 on the S&P? How will the Powell put get activated when there's only 100 basis points left to cut? And that's where the QE comes in and other stimulus packages come in, as we saw in 2009, increasing the debt. On the way up, the Fed should have been running stress tests and slowly increasing the rate to their 4 to 6% that they need before a large economic dip. The US wants rate cuts for the wrong reasons, it seems. So again, remember when we were hiking rates not too long ago, just a year ago, and rates were around 3 to 3.25%, and yet they were still not at that neutral or natural level. So what happened to neutral being above 3.5%? Why all these cuts? What can we expect from all of these cuts? What's to come? There's anticipation that this is the beginning of a rate cutting cycle, but it seems far too soon. There's now a change that we are going back to back rate cuts in September and October, then a last one in December, making it a total of 4 rate cuts in a span of about a year and a half. Here in front of me on the screen, you can see the probabilities of the rate cuts from September, October, and December, left to right. September, 95% pretty much priced in, 100% rate cut. 5% of a double rate cut or a 50 basis point cut is already priced in for September. One rate cut, 25 basis points, would get us down to the 175 to 200 basis point level. Now look at October. October, 62% for another rate cut. There's only a probability of 30% that it will be between 175 and 200, while there is a total of about 69% that it will be less than 175. Fast forward to December. December, we have large probabilities spread across the board, with the rate being at least 150 to 175 basis points. There's probabilities of it being lower, but as it's priced in, there will be at least 2 more rate cuts, it seems. So when it comes to mortgages, people think that rate cuts are amazing, right? Cheaper lending, right? It really depends on the mortgage type a customer or consumer has, fixed or variable. In a fixed mortgage scenario, the rate cut will have no effect on the monthly payment. It's a fixed rate, so it doesn't change for the existing homeowners. However, it can be attractive to some new home buyers as rates drop. Keep in mind that the Fed rate cuts affect short-term rates while mortgages last 20 plus years. That's a long-term rate which does not fluctuate as much as a short-term rate, meaning scattered effect on mortgages and even new home buyers. Variable mortgage payments usually see a slight decline. The variable mortgage is usually connected to the short-term treasury yield, which moves with the Fed rate changes. So there is a positive effect during these rate cuts, but slightly. Now let's look at credit cards. Credit card interest is similar to that of a mortgage. There are such things as variable and fixed rates for credit cards. However, variable rates are a lot less common generally. There is no real notice in fixed interest rates as we mentioned with the mortgages. Finally, into savings vehicles, savings accounts, risk-off vehicles. When interest rates drop, banks usually drop rates for everything, especially savings account, because they can't be paying out more than they're receiving. That is why we see banks take a hit in low-rate environments. Bank stocks usually drop, financials usually drop, and so on. The rate cuts are not instantaneous, but they take effect in a few weeks' time. They pay lower cash on certificates of deposit and money market accounts as well. These are considered conservative investment vehicles to park money at very little growth. In some cases, such as Germany, where they have experienced a negative interest rate environment, the government is issuing debt and bonds that holds a negative yield, meaning that people will have to pay to hold their money in bonds for the longer term for 30 years or so, rather than being compensated with coupon premiums as we generally see. So to conclude this little presentation, is the oncoming rate cut good or bad? In the current economic condition and future outlook, many investors may be opposed to the rate cut at the current time, but we have to see the longer term process. It's going to be very, very interesting to see markets react on September. Will they tank again? Will Fed Powell come out hawkish, or will there be a lot more dovish rhetoric to help markets finally hit a new high? Thanks for watching, everyone. This is Victoria from TRADEPRO Academy. I really hope you enjoyed that little piece, and I really hope you guys learned a lot. Get ready for that Fed cut announcement. We're anticipating a 25 basis point cut in just a few days. And if you enjoyed this video, drop a like. Let me know down below what you think. What should we follow up on in our next videos? And ring that little bell to notify you when we do go live every single day for our morning trading room. Take care.